Welcome to Iron Financial. I'm your lead analyst, and today we are firing up the heavy machinery to cut through the market noise, expose the structural weaknesses, and help you forge a stronger, more resilient portfolio. Right now, we are putting a legacy behemoth under the microscope. We're talking about the Coca-Cola Company. We are breaking down their Q1 2026 earnings report, and let me tell you, there is a whole lot of steel to inspect here, but we've also found a few potential cracks in the concrete. And I'm your market skeptic. Look, everyone knows Coca-Cola, right? It's a global staple, but just knowing the brand logo on the can doesn't mean you know the balance sheet. I'm here to represent you, the audience, and ask the tough questions. Is this stock actually an ironclad foundation for a 2026 portfolio, or are investors just blindly buying into legacy hype while the actual structural integrity rots away behind the scenes? That is exactly what we are going to drill down into today in this explainer. We're looking at top-line revenues, we're looking at debt, we're analyzing margins, and we are scrutinizing regional cash flows. Let's get straight to the blueprints.
Looking directly at Coca-Cola's Q1 2026 press release, the headline numbers are undeniably heavy. We are looking at a massive top-line beat, $12.47 billion in net revenues. That represents a 12% growth year over year. Global unit case volume is up 3%, and earnings per share grew 18% to 91 cents. On paper, at first glance, this looks like a skyscraper going up way ahead of schedule. Okay, but let's not start pouring the champagne over the foundation just yet. A 12% top-line growth sounds like solid steel, I'll give you that, but we have to contextualize this for the folks at home. Coca-Cola is a 130-plus-year-old consumer staples company. They are not some hyper-growth Silicon Valley tech startup. Seeing 12% revenue growth from a legacy beverage maker is highly unusual. Plus, the stock has already added about 7.9% since the beginning of the year, significantly outperforming the broader S&P 500's 4.8% gain. So my question is this growth actually sustainable, or is this legacy brand just surviving on aggressive price hikes and temporary market momentum? Are we looking at solid structural steel here, or is this just a fresh coat of paint over a deteriorating frame?
That brings us to the ultimate question for today's explainer. Is Coca-Cola's Q1 growth an ironclad opportunity to reinforce your holdings, or is it a market trap waiting to cave in on unsuspecting retail investors? Because let's remember the context here. Before this specific earnings release hit the wire, the estimate revisions kind for Coca-Cola was actually looking pretty unfavorable. The consensus had started to sour. Zacks Investment Research actually had it sitting at a rank 4, which is a sell rating. Exactly. And honestly, there were perfectly valid reasons for that downgrade. The market was absolutely terrified of peak inflation finally crushing consumer wallets, forcing families to trade down to generic, unbranded store brands. The fear was extreme consumer fatigue. So we need to know right now if this Q1 report is a genuinely solid foundation that permanently changes the narrative, or if it's full of hidden structural cracks that the trading algorithms just haven't priced in yet. I demand to know what's actually holding these massive numbers up. Fair enough. Put on your hard hats. It's time to start the drill down.
Section 1. The drill down. Top-line revenues.
We are firing up the heavy machinery to inspect the structural integrity of Coca-Cola's top-line revenue. This is where the heavy lifting happens, and we need to see exactly where these billions are flowing from. Let's drop the hammer on this massive $12.47 billion net revenue figure. That handily beats the Zacks consensus estimate of $12.3 billion. They also produced an adjusted earnings per share of 86 cents, absolutely crushing the 81-cent estimate. But here is the real rebar reinforcing this entire financial structure. Organic revenue grew by a massive 10%. 10% organic growth for a company of this sheer size is impressive heavy lifting for sure. But let's pause for a second. For the folks at home building their portfolios, what exactly does organic revenue mean in plain English? How is it fundamentally different from that 12% reported revenue we just talked about? That's a great question and absolutely crucial to understand. Organic revenue is pure operational muscle. It strips out all the noise. It removes currency exchange fluctuations, so you aren't just looking at the effects of a strong or weak US dollar. It also strips out the impact of buying or selling other businesses. It proves that the core engine of the company is growing through actual, genuine consumer demand, not just through clever accounting tricks or getting lucky with foreign exchange rates. It means people are actually buying more product, or paying more for it, organically.
Now, let's meticulously break down the actual materials used here. Global unit case volume grew by 3%. Hang on, let's define that metric too. Unit case volume. Right, unit case volume isn't about the dollar amount. This is the actual physical amount of liquid going down consumers' throats worldwide. It's a volume metric, not a pricing metric.
And the load-bearing pillars of that physical volume are fascinating when you dig in. Trademark Coca-Cola grew 2%, water, sports, coffee, and tea grew 5%. But the absolute heavy lifter in this quarter, the high-tensile steel of their entire portfolio, is Coca-Cola Zero Sugar, which spiked an incredible 13% across all geographic segments. I see that massive spike, and yeah, 13% is huge, but I also see some rust on the edges of this chart. Juice, value-added dairy, and plant-based beverages actually declined by 1% physically, dragged down heavily by Europe, the Middle East, and Africa. So it is not structural perfection across the board. We've got some sinking spots. True, but we need to inspect the blueprint notes carefully on that one. They actually sold off their finished product operations in Nigeria late last year. That divestiture directly impacted the dairy and juice volume numbers, temporarily dragging them down. It's not necessarily a lack of demand, it's a structural change in what they own. Overall, a 3% physical volume growth alongside that strong organic revenue shows they have serious pricing power without completely destroying physical consumer demand.
Hold on a second. I am inspecting the fine print of this data, and I've spotted what looks like a potential massive crack in the armor. The report explicitly states that organic revenues were driven by an 8% increase in concentrate sales. But you just literally said the unit case volume, the physical liquid actually bought by consumers, only grew by 3%. That is a massive 5-point discrepancy between what they are selling to bottlers and what is actually being consumed. Concentrate sales to bottlers are aggressively outpacing the actual volume of liquids going to end consumers. Is this real, durable growth, or is this a timing glitch artificially inflating the top-line revenue to make the quarter look better than it is?
That is a phenomenal catch, but let me aggressively clarify that discrepancy before we sound the alarm. You aren't looking at a structural failure, you are looking at a calendar distortion. The first quarter of 2026 actually had 6 additional days compared to Q1 of 2025. This was due to leap year timing and a quirk in their specific accounting period calendar shift. Those 6 extra days temporarily inflated the concentrate sales figures. It simply means bottlers bought more syrup purely because the reporting quarter was literally longer. This was slightly offset by the timing of shipments, but it completely accounts for that 5-point gap. It is temporary scaffolding, nothing more. The underlying 3% physical demand is solid, but the top-line concentrate number will reverse in the fourth quarter, which will subsequently have 6 fewer days to balance it out.
Section 2. The drill down. Profitability margins.
Okay, I'll accept the 6-day distortion for now. It makes sense. But as we say in the industry, top-line revenue is vanity. Profit margin is sanity. I want to shift focus from the top line to the structural supports holding the whole thing up, the profitability margins. If they are making more money but bleeding cash to do it, this whole structure eventually collapses under its own weight. Let's forensically examine those margins then. The operating margin came in at a highly impressive 35.0% compared to 32.9% in the prior year. If we look at the comparable non-GAAP margin, it expanded to 34.5% from 33.8%. Explain GAAP versus non-GAAP for us real quick, just to be crystal clear. Absolutely. GAAP stands for Generally Accepted Accounting Principles. That is the strict, standardized accounting rulebook every single public company uses. Non-GAAP strips out the noisy, one-time costs or temporary restructuring charges to show you the underlying day-to-day engine of the business. Either way you measure it here, the margins are made of pure titanium. Operating income absolutely surged by 19% to $4.36 billion.
Titanium? Let's not get carried away with the corporate sales pitch just yet. I'm looking at the broader macro environment. Inflation is swinging like a giant wrecking ball right now. Specifically, things like raw sugar, raw aluminum for millions of cans, and the fuel needed for massive global freight transportation. These raw input costs are brutal for manufacturers right now. How does this supposed structural integrity actually hold up against bleeding cash from those massive rising input costs? And what about their marketing expenditures? Coca-Cola spends billions just to stay culturally relevant. Are these intensely rising costs causing cracks in the armor?
They are absolutely facing severe headwinds. There's no denying that, but they are engineering their way straight through them. The margin expansion was largely driven by that massive organic revenue growth we talked about, and, crucially, lower operating expenses. They heavily reinforced the margins, even as inflation tried to chip away at the steel. Yes, they faced significantly higher input costs on raw materials, and yes, they significantly increased their marketing investments. Like what? What are they aggressively spending this capital on that makes it worth it? They're executing locally relevant marketing at an immense, almost unfathomable global scale. They rolled out a massive AI-enabled campaign for Chinese New Year. They ran huge Ramadan activations across the Middle East and Indonesia. They drove double-digit volume growth for Sprite in Brazil during Carnival. And they heavily activated Coca-Cola and Body Armor during March Madness in the US. They're spending heavily, for sure, have the capital to execute.
The return on investment here is proving to be highly structurally sound.
Section 3. The drill down. Regional volumes.
Let's move the inspection to the regional blueprints. A global conglomerate like Coca-Cola isn't just a single building, it's a sprawling complex. We need to see exactly where the growth is structurally sound and where the foundation might actually be sinking. Let's rapidly detail the pricing power across the strongest regions. In Europe, the Middle East, and Africa, which they call EMEA, volume was up 2%, but price and mix surged 5%. Let's define price/mix for the portfolio builders out there. That's a crucial term. Price/mix means they aren't just raising the sticker price of a standard 12-ounce can of Coke. They are also strategically shifting the mix of what people buy towards smaller, premium, higher-margin products. Think about those little 7.5-ounce mini cans. They cost more per ounce, which drives up the margin. In EMEA, that price/mix surged 5%. In North America, volume was up a robust 4%, with price and mix up 1%. In Latin America, volume was up 1% and price mix up 1%. In these specific regions, the concrete is completely cured and rock solid. They are aggressively passing costs onto the consumer, and the consumer is still enthusiastically buying.
Stop right there. I'm looking at the Asia-Pacific data, and I'm seeing a massive structural red flag. You cannot just gloss over this weakness. Asia-Pacific is incredibly important for Coca-Cola. It is supposed to be the high-growth frontier, the foundation for their next entire decade of volume. If APAC is cracking, the entire long-term growth narrative is in severe jeopardy. The region saw physical volume growth of 5%, but the pricing absolutely collapsed. What exactly is bleeding the Asia-Pacific segment dry?
Let's explicitly contrast the solid foundation of North American pricing power against Asia-Pacific to really see the damage here. In North America, as you mentioned, you have a positive 1% price and mix. Strong, stable. But in Asia-Pacific, the price and mix suffered a brutal 6% decline. The official report cites, quote, unfavorable mix and affordability initiatives. Let me translate that for you. That translates, to me, as them aggressively slashing prices just to keep the physical volume numbers up, because the Asian consumer is completely tapping out. That is a massive structural failure in pricing power.
I will admit, that is an undeniable structural weakness. The blueprint in Asia-Pacific requires immediate remediation. Due to those exact affordability initiatives, which literally means selling cheaper, heavily discounted products or pushing returnable glass bottles just to try and maintain market share, the operating income in Asia-Pacific suffered a severe 14% drop. If you look at comparable currency-neutral operating income, it plummeted an alarming 17% in that specific region. Asia-Pacific is the heavily rusted beam in an otherwise ironclad quarterly report. Value share there remained perfectly flat, with gains in Japan being completely offset by sharp, painful declines in India and Vietnam. So how heavy is that rusted beam compared to the rest of the structure? If India and Vietnam continue to bleed margins like this, does the whole building eventually come down? It's a significant beam for sure, but right now the North American and EMEO pillars are easily supporting the weight of the entire structure. North America operating income was up 20% and EMEA was up 18%. They absolutely need to patch the APAC rust, no doubt about it, but the overall structure isn't collapsing today.
Section 4. The drill down. Bottling and cash flow.
Let's pivot away from the regional variations for a minute and look at the ultimate financial steel holding everything together: bottling investments and free cash flow. Look, management can manipulate earnings on a spreadsheet, but cash flow is cold, hard concrete. And this concrete is incredibly thick. Coca-Cola is projecting a massive $12.2 billion in free cash flow for the full year 2026. This consists of $14.4 billion in cash flow from operations, less $2.2 billion in capital expenditures. And CapEx, capital expenditures, just to be clear, that's the money they have to forcefully reinvest into their own physical factories, bottling lines, machinery, and delivery trucks just to keep the physical machine running, correct? Exactly right. It's the cost of doing physical business. And even after paying $2.2 billion just to maintain the physical machinery, they still have a staggering $12.2 billion left over. Furthermore, their bottling investment segment saw an unbelievable 62% growth in operating income. This was driven by aggressive cost management and organic revenue growth, completely overpowering those higher raw input costs we worried about earlier. This kind of raw cash generation provides the ultimate shock absorption against any future market volatility. It is a massive moat.
Section 5. The verdict. Opportunity or trap?
We've stress-tested the top line, we've carefully examined the margins, we've unfortunately found the rust in Asia-Pacific, and we've measured the massive, undeniable cash flow. Now it is time to synthesize this raw data, to deliver a definitive, no-nonsense conclusion for the portfolio builders watching. Are they buying premium real estate here, or are they walking into a money pit? Here's the verdict, laid out in steel and concrete. The pros are undeniable, and, in my view, heavily outweigh the negatives. The heavy lifting is being driven by sustained, physical global volume growth, highlighted by that incredible 13% explosion in Coca-Cola Zero Sugar. They have immense, almost unyielding pricing power in North America and EMEA, impressively expanding operating margins to 35% despite sugar, aluminum, and freight costs actively trying to tear them down. And at the base of it all, they are generating a massive $12.2 billion in free cash flow. But let me forcefully remind everyone of the cons, because they matter. You cannot ignore the visible cracks in the Asia-Pacific segment. Operating income cratered by 14% there due to bleeding margins and forced affordability initiatives because consumers in places like India and Vietnam are simply tapped out. That rusted beam is heavy. Plus, remember that 6-day calendar distortion we discussed that artificially inflated those Q1 concentrate sales numbers by 5 full points? The underlying 3% volume is real, yes, but the massive 12% top-line revenue bait was partially an illusion aided by a quirk in the accounting calendar.
The forensic data is on the table. They beat earnings at 91 cents a share, they beat top-line revenue estimates, and they maintained their full-year guidance of 4 to 5% organic revenue growth. Even with the undeniable structural weakness over in Asia, the sheer weight of their cash flow and domestic pricing power makes this a formidable, highly resilient structure. It's strong steel, absolutely, but as investors, you always have to ensure you are buying it at the right valuation. Keep a very close eye on those raw input costs and watch closely for an APAC turnaround in the next quarter. If that rust spreads, it changes the math. So we leave you with this final, provocative question. Armed with this forensic breakdown, is Coca-Cola stock the durable, ironclad foundation your portfolio needs to cut through market weakness in 2026? Or will the cracks in the global consumer across Asia prove too heavy to bear in the long run? You have the blueprints. Now go forge a stronger portfolio. We'll see you next time for another explainer right here on Iron Financial.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.